Hi everyone, guys. Good morning.
Good morning, sir.
Good morning, sir.
All right, guys. So today we have this level one revision, or you can say doubt session. All right. So, guys, we can do it in two ways. So you can either ask me if you have any doubts, right? You can ask me questions, or I can ask you questions. Okay. Objective is to go through.
Sir, your voice is not clear.
Guys, check now. Is it better? Can you hear me properly?
Yes, sir.
Okay. See, guys, either I can ask you some questions from all the topics, or you can ask me the doubts. Okay, so it's like an open forum, just to make sure we are clear with what has been discussed so far. So maybe you can start with your questions, guys. If we have time left, then I'll ask you some questions. Okay. So I hope, first of all, everybody has got a chance to go through the topics we have discussed in level one. Yes or no, worries? Has everyone
Sir,
revised those things? Yeah.
I was not able to take the class for cash equities.
You
Actually, I
missed the
joined
class.
late. Yes, I joined late, and those classes were missed, and even the recorded class were not available in YouTube.
For
For
cash equity.
yes, sir, for only cash equities. Others are available, but cash equities is not available.
Okay. Every class is getting recorded. Did we miss the recording on that day?
Sir, actually, I
think-
joined 3 days late, sir. So it was covered on earlier days, so I missed those classes.
But I think we did the recording that day. Should be there.
Yes, I checked it. I covered all the misclass, but uh, those for cash equities, it is not there, sir, for now.
Okay, let me check on that. Okay, if not available here, we can share you the recording of the same topic in some other batch.
Yes, sir.
Okay.
Okay, sir. Yes.
I mean, same thing would be covered. Okay,
Okay.
But I think it is available.
it is available.
Sir.
So,
Sir, but the
Ashok,
recording, yes, sir,
Yeah.
but the recordings after 17th August are not available there.
Sir, it is available on that date, but the whole video is empty, sir. It's nothing there.
Yes, sir, it's absolutely. And I watched this video. It's empty actually.
can you share me the link, guys? Which link you are accessing?
Yes, sir.
Let me just double check that.
Yes.
Anybody share the link on the chat box, okay?
Sir, I've shared it in the Telegram group.
Yeah, sorry. Yeah, guys, I think you're right. 10th August recording is, there is nothing in there. The recording is there, but it's empty. But I think others are fine, right?
Yes, sir. Others are okay.
Yeah. Okay. See, guys, I think cash equities topic is missing here. So, anyways, whoever is facing any difficulty, just a second. Okay. All right, guys. I'll take care. I'll check this. Okay. I mean, you can just reach out to Damini. She will share the recording of cash equities, whoever is facing the challenge. If you have specific doubts, some questions related to cash equities, I am happy to take them. But if you want the entire recording, you can reach out to Damini, drop a mail to her, mentioning your name, batch number, and your query and your contact number. Yeah. And keep me in loop, keep me in CC. Okay. Uh, all right. That that is sorted. Any other issue, guys?
So can you
Any
explain equity swaps again?
equity swaps? Definitely, I can do that. All right. So, guys, you can use this class to clarify whatever doubts you have. I mean, we'll not be able to repeat everything, but small doubts we can definitely take. Okay. So let's start with the equity swaps. Guys, anybody would like to give it a try? Explain in 2-3 minutes what is equity swap?
Sir, may I?
Yeah, please.
equity swap, a financial derivative contract where a set of future cash flows are agreed to be exchanged between two counterparties as fixed dates in the future. It's a equity swap.
Okay. Okay. All right. See, in equity swap, what happens? Uh, the underlying is equity. Okay. So the payments will be exchanged on the basis of the performance of equity or the index. Yeah. So again, there'll be two parties who are entering into this contract. Yeah. They will have their opposite views. One party thinks that share price will go up or index level will go down. Other party will think the opposite. Okay. So they will swap the payments based on equity. Okay. Now, what happens is one leg would definitely be equity. The other leg can be equity or the interest rates. Okay. So one company or one party would make payments based on the performance of equity. And the other party may make payments based on equity or interest rates. Okay. So we took various examples like these, where one company is making the payments based on stock or performance index or stock performance. And the other party, company B, is making the payments on stock performance, index performance, or interest rates. Okay, so this can be another example where company A is making payments based on performance of Microsoft shares, whereas company B is making payments based on NASDAQ shares, like this. There can be many examples. Okay, now exactly what is your doubt? I mean, any particular thing in which you are stuck? Who asked this question?
No, sir, no doubt.
But it's a clear.
Yes, sir.
Okay, guys, use your, I mean, whatever doubt you have, you can ask me, okay, quickly.
Sir,
Yeah,
can you explain moneyness of the option again?
absolutely, absolutely.
And intrinsic value also.
Absolutely, absolutely. Okay, we talked about moneyness of the option. That means if you immediately exercise the option, if the option buyer immediately chooses to exercise the option, will he have a positive payoff, zero payoff, or negative payoff? Okay. For example, let's say I have bought a call option with strike price of 200. So I can buy the asset at 200, right? Let's say the current market price of the asset is 300. So if I immediately exercise this option, will I have a positive payoff or a negative payoff? Tell me, anyone?
Positive payoff, sir.
Positive payoff. Why? Because I'll be able to buy at 200 when it is available at 300, right? So I'll be able to buy it 100 rupees cheaper. Yeah, so it's like a profit of 100, right? So we call it positive payoff. Yeah. If the option at the current juncture is giving you positive payoff, it is known as in the money. Right now, it is in the money. Okay. Let's suppose tomorrow the current market price falls to 150. Now this option is what? Out of the money. If I exercise this option now, I lose. So I'd rather not exercise, right? So we call it out of the money. The three makes sense or not?
Um, can you say explain out of the
Out of the
money option?
money. Okay. See, this option, which I have highlighted, here I can buy the asset at 200, right? But the asset is available in the market at 150. So would I like to exercise this option?
No.
No, right? Why would I buy something for 200 when it is available in the market for 150, right?
150. Yes.
So I will not exercise this option. Yeah.
Okay.
So if I exercise, I will have a negative payoff. Yeah.
Yes.
So if the immediate exercise of the option gives me a negative payoff, what do I call it? Out of the
Out
money.
of the money.
So
Okay.
right now, this is out of the money.
Okay.
Sir,
Just a second, she asked about intrinsic value also. So see, now taking the same example for simplicity's sake, we have the call option with a strike price of 200 and current market price is 150. So will you exercise this option, guys? Anybody?
no, sir.
We will
No.
not exercise, right? So what will be the intrinsic value?
0.
Premium.
Intrinsic value is 0. Okay. Let me take one more example. This is what? This is in the money or out of the money? This one?
Out the money.
Let's say call option is a strike. Current market price is 200. So is this in the money or out of the money?
At the money.
At the money.
Will you exercise this option? No. What is the intrinsic value? 0.
0.
Okay. Let me take the third scenario. Okay, current market price is 300. Now, what is this? It is in the money. Yeah. Will you exercise this option? Yes. Right. What is the intrinsic value? 100. Okay. So the intrinsic value is the gain you can make by exercising the option. It is the gain you can make by exercising the option. When will you choose to exercise? When you are making gains, right? So you obviously cannot lose, right? So intrinsic value would never go below 0. So intrinsic value of this call option is 0 or more than 0. For any option, the intrinsic value can never be below 0, can never be negative. Okay, it is the gain you can make by exercising the option. Are we clear?
Yes, sir.
Okay.
Sir, in case of any option, if the strike price and the current market price are same,
Yeah.
So, I mean, is it mandatory that you will not exercise the option? I mean,
No,
the person will be indifferent whether they want to buy or not. It totally
yeah, I
depends.
mean, yeah, uh, it's really uh, option holders call. Yeah, but as such, he can directly buy from the market also, or he may choose to buy it here. Doesn't really make a difference. Okay? So you rightly said that he would be neutral. He may exercise, may not exercise. It's not a mandatory thing that he will not exercise. It's not a rule. Okay, it's up to him.
Okay, sir.
Sir,
Yeah.
sir, I have a doubt regarding the premiums in the money, out the money, and at the money. Why is the premium high is in the money option and low in the out the money?
Okay. Uh, the demand for which call option would be higher?
In the money, sir.
This one, right?
Yes, sir.
Because if you have this, you are in gains, right? So you are already making a gain of 100 if you have this, right? So would somebody sell you this for below 100?
No, sir.
Why would he sell it for 80 rupees or 90 rupees? He can make at least 100 rupees by doing it in the market, right? So he would obviously sell it for more than 100. Yeah. So the premium would be more than 100 in this case. Whereas in this case, the intrinsic value is 0. Yeah. So as such, this call option doesn't have any value. Only value it has is time value. Right. So the premium would obviously be lower. Okay. If you remember what is premium, premium is
Time
intrinsic,
value plus intrinsic value.
absolutely. Intrinsic value plus time value. So time value will always be there when you have some time to expiry. Intrinsic value can be 0 also. So the overall premium or the price of the option would depend upon both.
So in this we can compare with the time value of money.
Yeah, I mean, even this option would not be selling for 0 rupees.
Yes, sir.
It would also be selling for 5, 10 rupees maybe. That would be the time value.
Sir, in the option contract,
Yeah.
the buyer enters into the call option buyer or the put option seller is entered into the contract because of the, I mean, say ki, high volatility in the market of call and put of the buyer. They have the right to sell, right to buy the shares.
Yeah. You are asking something?
Yes, I mean, what is the high volatility? High volatility goes down.
Volatility is the change in share price, change in the price of something, change in the value of something is volatility. Okay. For example, you know Virat Kohli.
Yes, sir.
Yeah. You know Sehwag.
Yes, sir.
Yeah. Let's say in 5 innings, Virat Kohli scores 45, Sehwag scores 10. In the second innings, Virat Kohli scores 52, Sehwag scores 98. In the third innings, Virat Kohli scores 49, Sehwag scores 82. In the fourth innings, Virat Kohli scores 55, Sehwag scores 0. In the fifth innings, Virat Kohli scores 50, he scores 44. Can you tell me who is more volatile? See, guys, it's we are talking about variation, right? Here I'll use the word consistent. Yeah. Here I'll use there is a lot of variation, volatility in terms of the numbers, the score he will make, right? It's very difficult to predict this thing, whereas it is comparatively easier to predict this thing, right? So this is what we mean by volatility. Sometimes down, sometimes up, sometimes down, sometimes up. This is the uncertainty. This is the volatility. Are we clear?
Yes, sir. Sir,
Yeah.
sir, we can say that in call options, call option is we can say that is for upside betting, one-sided betting of one party,
Yeah.
and put option is for downside betting of the one party.
See, are you talking about call option buyer?
Yes, sir. Call option buyer, long
Yeah.
position.
Yeah. That obviously you will take if you expect the asset price to go up, right? Yeah, guys, please ask any other question.
Sir, can you please explain NDF contract?
Sure, sure. Okay. Okay, so this is an NDF contract. What happens here is you have two forex trades. Okay, just like in a forex swap, we have two forex trades. Here also we have two forex trades. But there we have different settlement dates. Here we have different trade dates, but the same settlement date. Okay, here we may not have an NDF currency. Here we'll have an NDF currency. Okay, so one currency will be the non-deliverable. The other currency would be the deliverable one. Okay, so the major currency would be the deliverable, and the other currency would be non-deliverable. For example, if you look at this pair, USD will be the deliverable currency, whereas INR will not be the deliverable. What do we mean by deliverable currency is all the profit or loss will be calculated in USD only. Okay. So one party will have a certain gain in USD and the other party will have the same loss in USD. Okay. Now what is happening, guys? Two parties are making a bet on currencies. Yeah. One would think USD will go up. The other would think USD would go down or may not go up as much as the other party thinks. Yeah. So it's like taking a bet on the currencies. Yeah. If you are bullish on USD, if you expect the USD to go up, what will you do? You will buy the USD today and sell it later. Yeah. And vice versa. Yeah. It's just like asset price. If I expect the asset price to go up, I buy it today and sell it tomorrow. Yeah. Just like that. So two parties with opposite views would get into this NDF contract. What are the features of the contract? Same settlement date, but different trade rates. Exchange of currencies never happen. Only the net profit or loss is calculated in terms of deliverable currency, and that net profit or loss is exchanged between the two parties. Okay. That's about it. I mean, you enter into the trade for a particular settlement day. You say that, okay, I'll buy this much of this currency at this rate on this date. Then just 2 or 3 days prior to that date, you check with the RBI that what is the settlement rate for what is the fixed rate for what is the fixing rate, sorry, for 5th August, and RBI would tell you it is 68.4. So that's fine. I mean, you betted on 70, now it is 68.4. So slight loss. So you need to pay. Okay, so this is what you pay. The bet was of this, but you don't exchange this much amount. Notional amount is never exchanged. Only the net gain or loss is exchanged. So go through this. If you have any doubt, let me know.
Sir,
Yeah,
sir, I have a little doubt in the what is mean by the term innovation process.
I'll tell you first. Let's clear this one.
The flattening out of the currency means that there will be no inflow or outflow of INR or the non-deliverable currency.
Yeah. Uh, by word, what we mean is same amount would be bought and sold. Okay. So there is no gain or loss in this. There is no difference in this. Right. That's what we mean by flattening out. Okay. So obviously, if you flatten out other currency, the gain or loss will be in some other currency, right? If I am flattening out INR, the gain and loss would obviously be in USD. Is this clear?
Yes, sir.
Sir,
Yeah.
sir, NDF contract is done to lessen the loss portion.
Sorry.
Is NDF contract done to lessen the loss portion that is expected?
One party will pay the loss. That's what you are asking?
Yes, sir. Yes.
Yeah, obviously. Who will pay this amount? The party in loss, right?
Okay. If the exchange rate was 70 or higher than that, then they would not have entered in the that second trade. That second trade.
No, no, no. It's not optional.
Okay, sir. Okay.
It's not optional, okay? Okay, guys, who asked this question? NDF contract.
Paridhi.
Parit, is it clear to you?
Yes, sir.
Okay. Guys, we can move to the next question. Anyone wants to ask anything?
Sir,
Yeah.
direct and indirect quotation. Yep.
Okay. Okay. We did this in foreign exchange, right?
Yes, sir.
Okay. So if you are mentioning the exchange rate between the two currencies, you can mention it like this, or you can mention it like this. It's the exchange rate between USD and INR. Okay. Now I want it in a certain way. Okay. I like this. So what I'm asking you, give me direct quotation of INR against USD. Okay, I am an Indian. I'm asking you, give me the direct quotation of INR against USD. So basically, I am not asking you for this. I am asking you for this. Okay. Mathematically, these two are the same things. I hope you understand, right? But it's just a way of representing them. So one we call as direct, one other we call as indirect. Okay, so if an Indian is asking for a direct quote, what will you give him? You will give him this one. If an American is asking for a direct quote, what will you give him? You will give him this. Okay. So direct quotation is 1 unit of foreign currency, 1 unit of foreign currency in terms of local currency, in terms of local currency. That is direct quotation. Okay, and vice versa. So just go through this. If you have doubt, let me. Yeah, who asked the doubt?
Sir, I asked the question.
Yeah, Nastri.
So it means that if you are saying you can ask that when I want the currency in $1, $1 equal to 74 Indian rupees. So yeah, which is the 1 Indian rupees equal to 0.0135 US dollar would be indirect, and $1 equal to 74 Indian rupees direct. Got.
Yes. Yes.
Okay.
From a Indian perspective, this will be the direct quote, and this will be the indirect. Whereas from an
Okay.
American perspective, this would be indirect quote, and this would be direct.
Okay. Okay. Can I write that down, sir?
Yeah, yeah, please.
Thank you.
It was written earlier also. Maybe you missed it.
No, actually, sir, you have written that in the Indian perspective and American perspective now.
Yeah, I mean it was written earlier also.
I brought down everything from
Okay.
direct.
No worries. So take your time. Okay.
Yeah, okay.
No worries.
Sir, I have a question.
Yeah, please ask.
Sir, what is innovation process in the
Oh
financial
yes.
participant?
I'll take it next. Okay. Let's complete this, then I'll take it.
So you can continue.
All right. So next we have the novation process. Guys, anybody would like to take this question? Anybody knows about this?
So can I try?
Yeah, please.
So whenever the clearing houses are the financial institution that act as an intermediary between the buyer and seller. So what happens when in an exchange there is matching of the trade? The once the transactions are matched, these matched orders or transaction are sent to the clearing houses. Now these clearing houses act as a seller for the buyer and buyer for the seller. So what happened is these clearing houses comes between the trade and they break the transaction into two parts, becoming the buyer for the seller and seller for the buyer. And this process is called as novation. That is when the clearing houses intervenes and breaks the transaction and become the buyer and seller for the two other parties. This process is called as novation.
Absolutely. Very good explanation, Pariti. Well done. Reswal, I hope it's clear.
So can you again explain, sir?
Okay. I'll say exactly what she said because she said it perfectly. Once you place an order on your broker's portal, for example, I showed you HDFC Securities, right? I can place a buy or sell order there. Yeah. So once you place an order, what happens? The order goes to the exchange, and the exchange would do the order matching. Okay, based on rules. So they will match the orders based on the price you have mentioned, based on the quantity you want, based on the time when you punched the order, right? So based on all these criteria, the order matching will be done by the exchange. Yeah. Once the order is matched, so buy order is matched with the sell order, these executed trades would be passed to the clearing house. Okay, now clearing house would take the ownership of these trades. Okay, so what it will do, it will break the trade into two parts. The person who asked to buy the shares, clearing house would become a seller for it. And the person who asked to sell the shares, the clearing house would become a buyer for it. Okay, so for every seller, clearing house would become the buyer, and for every buyer, clearing house would become the seller. Okay, it has become the counterparty for each participant. Okay, and that is why we say settlement is guaranteed. Why? because if the counterparty is clearing house, we don't have to worry about it, right? Settlement would happen. This process is called nomination. When the clearing house takes the ownership of the trade, becomes the counterparty for each party. This process is known as novation. Is it clear?
Yes. Sir, I have one more question.
Yeah, please ask.
Sir, in the financial participants topic, who are the custodians basically and what they do basically?
Custodian. Okay, we'll talk more about the role of custodian in level 2. Okay, it is a slightly advanced concept, but for your basic understanding, custodian is someone who takes care of the assets. Okay, who safeguards the assets. Now, in the world of institutional investors such as mutual fund, hedge fund, these institutes mandatorily need to have a custodian account. Okay, so what custodian would do? Custodian will hold the securities for their clients. Custodian will hold the cash for their clients. Custodian can help in the trade execution, trade settlement. Okay. For now, just understand this. We'll talk more about it in level 2.
Yes.
Yeah, guys. Please ask.
Sir, one more question.
Yeah, ask.
Sir, participating versus non-participating preferentials.
Okay. Guys, anybody would like to try this? Participating preference
Okay.
shares person? Yeah.
Participating shares are those shares that the company have to pay some extra dividends and not the over the fixed dividend. And in non-participating, the receiver would get only fixed dividends.
I mean, yeah, they can get, okay. For example, what happens is usually we see just okay, if you see this, what happens if you have, let's say, the par value of 8%. Let's say you have 5% $100 value preference shares. Okay. What is the dividend you would expect from them every year? 5% of $100. So $5, right? You would expect these preference shares to pay you a dividend of $5 every year, right? Now, if the company makes 1,000 crore profits, if the company makes 4,000 crore profits, would there be any difference in the dividend you are getting? If the company makes profits of 1,000 crores, or if the company makes profits of 4,000 crores, would there be any difference in terms of the dividend you are getting? Guys, say yes or no.
No, sir.
No, right? Your dividend is fixed. But what if I say these are 5%? $100 face value, participating preference shares. What does this mean? That now, if the company makes more profits, they have the option. They may give you more dividend than $5. Okay, so they may give you additional dividend. It can be $1, $2, $3, $10, anything. They can give you additional dividends if they have a lot of profits which they want to distribute. Okay, it will be the decision of board of directors only whether they actually want to give it or not, but at least they have an option of giving extra dividend here. They don't even have the option here of giving extra. Got it?
Yes.
Why do companies will issue like non-participating and non-cumulative preference shares?
Non-participating. I mean, by default, it is non-participating. For example, if I just mention this is non-participating. Why not issue this? I mean, you don't have any obligation apart from 5, right? But here they may ask you, why are we not getting extra dividends when we are having more profits, right?
Sir,
Yeah,
one more question I
yeah,
have
ask.
regarding the fixed instrument topic.
Yeah, tell
That
me.
means that secured bond versus unsecured bond, and why the government bonds are safest unsecured bonds.
Okay. Secured bonds are those bonds which are backed by specific assets of the issuer. Okay. Secured bonds are those bonds which are backed by specific assets of the issuer.
Sir,
Yeah.
sir, it means in secured bonds, if the default in the payment of the investor, they can claim their asset. That's it.
Yeah.
Okay, sir.
Whereas unsecured are not backed by. Okay. So if they default, you cannot say that, okay, I'll sell this factory and get my money. Yeah. They are not backed by any specific assets. But in this case, they are backed by specific assets. It can be a building, it can be the cash of the company, it can be the uh, bonds, government bonds which the company holds. It can be any asset. Okay, so you are more secure here. That's why they are called secure. And why do we call government bonds as safest unsecured bonds? Because see, they are unsecured. Why? Because they are not backed by specific assets. I mean, you cannot sell the land of government, or you cannot sell the highway built by the government. Yeah. So as such, no specific assets are backing them. But still we call them safe. In fact, we call them safest because we don't expect the government to default, right? Who controls RBI? Government controls RBI, right? It's a government entity. Government controls RBI, right? So RBI can print money. So obviously, they will never default because they can print money and satisfy the obligation, right? That's why we call that safest. Okay.
Okay, sir.
So can you explain credit events?
Credit events. Okay. In case of credit default swap, You're asking in that terms, right?
Yes, sir.
Okay. So if you see here, guys, when is the CDS buyer gets paid? If credit event happens, right? Now, what could be this credit event? It could be bankruptcy. That means the bond issuer, says, I'm bankrupt. Obviously, I cannot make the coupon payments now. Okay. So in that case, it would be considered as a credit event, that a credit event has happened. Now the CDS seller needs to pay to the CDS buyer. Okay, so these are the events when the CDS seller would need to pay the amount to the CDS buyer. If any of these events happen, then CDS seller needs to pay. Okay, so it can be bankruptcy declared by the bond issuer. It can be moratorium period declared by the bond issuer. It can be restructuring which the bond issuer is going through, so it is not able to pay the coupon payments on time. So uh, these would be the, I mean, this is not a comprehensive list of credit events, guys. These are just some of the cases when uh, it would be considered as a credit event. Exactly what are the events which they would consider as credit events would be mentioned in the contract.
And sir, LGD,
Yeah. And what?
loss given default.
Loss given default is if the credit event happens, they need to pay an amount, right? How much? How much do they need to pay? Okay, that is loss given. Yeah. So how much money they need to pay is the loss given default. Okay. So how do you calculate? Whatever you can recover from the market, recover that. The rest of the things would be paid by the CDS seller. All right. So that's why it is 1 minus recovery. So if you can recover 40% of the value of the bond, 60% would be paid by the CDS seller to the CDS buyer. Is that clear?
Yes, sir.
So what is the meaning of zero sum game?
Zero sum.
Zero sum game in derivative.
Zero sum game. Okay. Anybody would like to take this question, guys? What do we mean by zero sum game?
Sir,
Yeah.
Sir, the
Yeah. Tell me.
sir, the gain of one party is the loss of another party.
Yeah, basically correct. It's very simple. So if two parties are entering into a contract, then one party would be in gain, the other party would be in loss. By zero sum game, what we mean is if one party is in a loss of 100, the other party will be in gain of 100.
Okay, sir.
So if you sum the profit and loss, it will become zero. Okay. Same profit, same loss.
So, can you explain the difference between commercial paper and certificate of deposit?
Yes, both are money market instruments and both are unsecured, both are promissory notes. So where is the difference? Guys, anybody can tell me what is the difference between commercial paper and certificate of deposits?
So certificate of deposit issued at face value and redeemed at face value plus interest, and commercial paper are issued at a discount rate and redeemed at face value.
Mhm. Yeah. And in terms of issuer,
Commercial papers are issued by large corporations, and whereas certificates of deposits are issued by banks and financial institutions.
yes. So I'm just looking for it. Okay, just a second. I'm just looking at where it was discussed. So just give me a second. Yeah. It's- yeah, found it. So here we have certificate of deposits, and here we have the commercial paper. So, I mean, your confusion is makes sense because they are very similar. Only thing is, I'll say that certificate of deposits are usually issued by banks. Okay, I mean, they are almost always issued by banks, whereas commercial paper would be issued by corporates. Okay, so if banks need some short-term money, they would use certificate of deposits. Whereas if corporates need some money for some time, they would use commercial paper. Okay, so first difference is in terms of who generally issues them. Okay, the second difference is in the certificate of deposit, we also call them CDs. These are known as CDs. Okay, in CDs, they are issued at face value and redeemed at face value plus interest. So they'll be issued at face value. Let's say they'll be issued at 10 million for one CD. Okay, that's the face value. Whereas when you redeem it back, you will get 10 million plus, let's say, 1 million interest. Okay, so they are redeemed at face value plus interest, certificate of deposits. Whereas in commercial paper, they are issued at a discount. Issued or sold at a discount and redeemed at par. For example, issued at 90,000 and redeemed at the rounded off value. That is the face value. Okay, so this would be, let's say, issued at 9.8 million, and it would be redeemed at face value, that is 10. Okay, but apart from that, there are a lot of similarities, and I may ask you question regarding these. What are the similarities and what are the differences between CDs and CPs? Okay. All right. If it is clear, we can move to the next question.
Yes, sir.
Sir,
Yeah.
I have a question.
Yeah.
So the basic difference between current yield and the YTM, yield to maturity.
Okay. Anybody would like to take this question, guys? Current yield versus YTM, yield to maturity.
Current yield is the annual return that we would get in form of coupon payment. And when we talk about yield to maturity, it is the annual return that we'll get in the form of coupon payment as well as capital appreciation.
Yeah, absolutely. Okay. That's the main point. Basically, current yield only captures the returns in the form of coupon payments. So If I invest in the bond at the current market price, what is the return I'll get in the form of coupon payments only? That would be my current yield. Okay. For example, look at this, we discussed this. Let's say there is a bond which is trading at 950. So if I want to buy this bond, how much do I need to pay? 950, right? And what is the coupon I'll get? 80. So what is my returns in the form of coupon payments? 8.4%. This is what we call as current. The returns in the form of coupon payments only are known as current. Are we clear with this?
Yes, sir.
Okay. Whereas if you look at the total returns, you not only get the coupon, but you will also get these 1,000 rupees, right? So 50 rupees extra, right? Yeah. Well, so in this case, if you look at the yield to maturity, it will capture both the returns. First of all, you are getting the returns in the form of coupon payments and also capital appreciation of 50, right? So yield to maturity would capture both these types of returns. Okay. So in this case, it would be more than 8.4%.
Sir,
Yeah.
sir, in assumption, what does the second line mean? You reinvest the interim cash flow at the
Okay. So these are the interim cash flows. Okay. 80/80. So you don't keep 80 in your pocket. What you need to do, you need to invest 80 for 2 years. You need to invest this 80 for 1 year. Okay. So that's what we mean by you reinvest the interim cash flows at the rate of. So you need to reinvest them. Let's say my YTM is 10%. So I need to reinvest them at 10% per annum. I have to find a source of investment. I have to find a good investment option which can give me 10% return on these interim cash flows. That's where I'll invest them. Okay. If I don't invest them, my YTM will not be 10%. It will be lower than that. YTM of 10% means I am also reinvesting these cash flows at 10%. That's when I'll overall get 10% return. Got it?
Yes, sir. Sir,
Yeah.
sir, in this, is there any situation when current yield is greater than YTM?
Yeah, it can be. For example, if you look at this bond, let's say a premium bond, yeah, it is selling for 1,200. If you invest in 1,200, this is what you are going to get. So your current yield would be more than the YTM. Yeah, because you are having a capital depreciation here. Yeah, so your current yield would be more than YTM. Guys, please ask. No other questions?
Sir,
Yeah.
sir, in swap derivatives, there is interest rate swap, and the second type basis swap. This means floating versus floating. So
Yeah.
can you give one example of that?
Yeah, I mean, let's say, um, so, so as I said, I mean, it's floating versus floating. So let's say you expect one rate to go up, whereas not the other one. Okay, and the other party expects the opposite. Okay, so you can take any reference rates. This is just an example. You can take any reference rates which keep on changing, and one party expects the one rate to go up, whereas the other rate to come down, whereas other party expects the opposite. So they can enter into this contract. For example, in this case, company A expects LIBOR to go down. Okay, Euribor to go up. No, sorry. They are making payments based on LIBOR. So if it is 2%, they will make 2% of that. Uh, uh, yeah. So they expect LIBOR to not go up too much, right? Whereas they expect Euribor to go up. Yeah. Company A expects Euribor to go up. Why? Because they are receiving the payments based on Euribor. So the more it goes up, the more payment they will receive. Yeah. Whereas they have to pay based on LIBOR, so they don't want LIBOR to go up very much. They want LIBOR to go down. That's why they are paying based on LIBOR. Make sense?
Yes, sir. Sir, here we consider the share price also floating versus floating.
No. That will be a equity swap.
Okay, sir.
That you can talk about like this. Okay? That would be an equity contract. Okay. What else, guys?
Sir,
Yeah.
can't we leave the meeting class early? I still have so many topics to revise.
Okay. So why is it still pending, Nasreen?
Uh, it is taking so much of my time to complete one topic. Uh, this is difficult for me, I guess.
No worries. You put in extra effort, okay? And I'm sure you will do well. So
Sorry.
please put in. I'm saying please put in that extra effort because you're not from that background. Maybe that's why it's taking more time. But
Yes, sir.
please put in the extra effort, okay? You will do well.
So can I leave early?
Yeah, I mean, if you don't have any doubt and you don't want to listen to the discussion, that's up to you. I'll mark you
Yes, sir.
present, okay?
Okay, sir. Thank you.
All right.
Thank you, sir. Bye, sir.
Bye. What about others, guys? Any doubts? I can see some people asking me doubts. I mean, what about others? Everything is clear or nothing is clear?
Sir, sir,
Yeah.
sir, I'm very fearing regarding the tomorrow's interview session.
Sorry, what are you saying?
Sir, very scary.
Very scared. You're scared. Why?
I don't know why, but something is scary.
Guys, are you scared out of me or because of the curriculum?
Not with the curriculum, the way I
Because
should,
of me.
the way I should to present someone that's fear of that.
No, no, don't worry. That's a learning phase, right? So nobody knows the exact way to do it or exact answer to everything. That's okay. Okay, that's a learn. That's what we are trying to learn. So feel free to make mistakes. It's like a practice. It's like a dress rehearsal for your final company interviews. The objective is we should not be making mistakes at that time. Right now, it's fine. Don't feel scared, guys. Just keep on working hard. Yeah. Yeah, guys. Any other question, or should I ask you questions? Okay. I think you are running out of questions, so I'll ask you questions now. What is the difference between a rights issue and a follow-on public offering? Okay, let me extend this. What is the difference between IPO, FPO, and rights issue? Guys, you can raise your hands. Whoever wants to answer, I'll pick one person, okay? I hope everybody knows how to raise hands. Just search for that option, raise your hands, and I'll ask you that. The difference between IPO, FPO, and rights issue. Not even a single hand is raised till now. Okay, Parichay, please go ahead. Yeah.
Sir, I only know about IPO and FPO, not.
That's okay. Tell me.
Sir, IPO is the initial public offering when a company issues its share for the very first time to the general public, and that is known
Yeah,
as IPO. And FPO is known as a follow-on public offering, which is reissued or issued again to the general public.
right. So whenever a private company issues the shares to the general public for the very first time, it is IPO. And when a public company does it again, it's an FPO. Yeah. What is a rights issue? I think we might not have discussed that. Maybe that's why you are getting confused.
Yes,
Anyways,
sir, I think we haven't
it's
discussed.
yeah, we'll discuss it in level 2. Okay, so I'll ask you. Okay, what do we mean by underwriting? Investment banks provide underwriting services. What do we mean by underwriting the IPO? Please raise hands,
Sir,
whoever wants to try. Yeah, but I will just wait for others also. What do we mean by underwriting services provided by the investment banks? Yeah, Parinsay, go ahead.
sir, it is the commitment and the best effort that has made by the investment banks to the company at the time of issuing IPO.
Okay. Anushka, you want to add?
Sir, it is the process basically by which the investment bankers raise the investment capital on behalf of corporation.
It is the entire process.
Yeah, the whole process is known as underwriting.
Okay. What do they do? I mean, it's little more detail.
They take the risk of the company of raising their capital.
Yeah,
Sir,
yeah.
can you one more repeat the question? My electricity just go off. That's why I just.
Yeah, we are discussing underwriting services provided by the investment bank. What do we mean by underwriting services? Guys, tell me, Paridi.
The process of raising capital and undertaking the risk for that company, in which like there are two broad term like firm commitment and best effort commitment. So in firm commitment, they actually commit that if the general public is not able to subscribe fully, then they will be providing their support by by subscribing. Whereas in best effort commitment, they say that they will be committing the service to the best effort they can put in order to have the successful IPO.
Yeah, right. So there is no commitment in that sense. In that case, investor, but they just do their best to make sure that all the shares are subscribed. Yeah, but in fixed commitment, they will make a commitment that okay, we are there. I mean, we will be buying the shares, and the company doesn't need to worry whether the shares would be issued or not, whether they would be able to raise money or not. The investment bank will take the responsibility. If not subscribed in the market, they will be the buyers. So that's a fixed thing. All right. What is a red herring prospectus? Why is it used? What is a red herring prospectus?
Sir,
Why and when is it used?
Sir,
Yes, please raise your hands if anybody wants to answer.
sir, red herring prospectus is like an annual report of the company in which the company has the financials, product and services management of the company, vision of the company, like that. And the investment bank have to create this DRHP for the company. They have to file it to the SEBI, and SEBI would note to them, and SEBI would suggest some certain changes to it if it is not done properly.
Yeah, see, the objective is earlier it was a private company, so nobody knows about the company. So how do you float the information for everyone? Yeah. So what do? You publish a red herring prospectus. You with the help of investment bank, the company would submit the prospectus with the SEBI. Once they approve it, it will be on the exchange. Right on the exchange website, you can go and look at the prospectus of the private company. And whatever details you need to know about the company or the IPO, those details will be there. And you can take an informed decision after reading the prospectus whether you want to invest or not. Right? So it's for the information purpose of everyone who wants to invest in the shares of the company or who just wants to know about the company. They can look at the prospectus and get all the information. I hope everybody knows about this, guys. Am I right?
Yes, sir.
Okay, what are inflation index bonds? What are inflation index bonds, guys?
Sir,
Anybody?
the model.
Please raise your hands. Yeah, Anushka.
So in these bonds, we cut out or we kill the inflation risk of an investment where the principal and coupon increases to compensate the inflation.
Yeah. Uh, Conceptually, you are correct, right? So, yes, the idea behind the inflation index bonds is to protect the investors from the inflation risk, right? So, what happens based on the inflation rate, the principal amount is readjusted and the coupon amount is calculated based on that readjusted principal amount. Okay, so if inflation is 5%, the principal amount would automatically be increased by 5%, and the coupon would be calculated based on that increased principal amount. So obviously the coupon payment would also go up, right? So the increased coupon and increased principal amount would compensate the investor for the loss of purchasing power due to inflation. I hope everybody is clear, guys. If you have any doubt, let me know. When would any bond be trading at a discount or at par or at a premium? When would any bond be trading at a discount, par, or premium? Yeah, Rizwan.
Sir, if the coupon rate is less than the market rate, the current market rate, then we generally issue at a discount of that bond issue. If the coupon
Yeah,
rate, if the coupon rate
right.
is greater than the market rate, then we issue at this bond at a premium. If the coupon rate is equals to market rate, then we issue at par at face value.
Yeah, I mean, not only issuance, but if you look at what price they would be trading, if the coupon rate they are offering is lower than the current market rate, then they would be trading at a discount to par value, right?
Yes.
So any bond which is offering coupon rate of less than the market interest rates would be trading at a discount. Any bond which is offering the same coupon as the market rate would be trading at par value, and any bond which is offering you more coupon rate than the market interest rate would be trading at a premium. Okay, why do banks may use interbank lending facility? Why the banks may use interbank lending facility? Check.
Sir, to meet the requirement of the bank like SLR and CRR, uh, and sir, there's no intermediaries are involved, so the interest rate is very low, and they can earn interest by lending money to some other bank.
Yeah. So basically, they can have short-term need of funds. That's why they can use interbank lending facility. They may need to maintain certain ratios as set by the regulator. So that's why they will use the interbank lending facility. They may have surplus funds also, yeah, which they want to earn returns on for some time. So they might use interbank lending facility for that also. Yeah. So it's a market where the banks exchange funds to take care of their surpluses and shortages. Okay. Who is known as a speculator and who is known as a hedger in the financial market? Yeah, Paridi.
A person who takes the risk in order to earn profit in future is called a speculator, or we can say that a person who anticipates and take the risk to earn future, and a hedger is a person who is trying to mitigate the element of risk that is involved in a transaction.
Okay. Um, Anybody would like to add to what she said? Reswal?
Sir,
Yeah.
basically speculator is a risk seeker and take a position how to make profit, and hedger is a risk averse, taking a position to eliminate that type of risk.
See, guys, your answers are incomplete. What you should say is speculator is someone who may not be facing any risk currently. Okay, he doesn't have any exposure, he's not facing any risk, but he's taking an exposure now, he's taking a risk now to make profits. Okay, for example, if I don't have any shares, nothing, right? I don't have any risk, right? I'm not facing any risk. But if I buy the shares and try to make profits from buying and selling of shares, I'm speculating, right? I'm taking a risk. When I'm buying a share, I'm taking a risk, right? To make profits. So I'll be known as a speculator. Okay. So speculator is someone who is not facing any risk currently, but who is willing to take risk to make profits. Okay. Hedger is someone who is facing the risk currently. Okay, who has the exposure currently and he doesn't like it. He wants to kill that risk. Okay. For example, if I'm worried that my share can go down, what will I do? I'll buy a put option. So I'll try to hedge my risk. Yeah. If I hold the shares of, let's say, Maruti Suzuki, and I'm worried that the share price may go down, so that's the risk I'm facing. How do I protect myself from the risk? By taking a put option. So what I'm doing, I'm buying a put option to hedge my risk. I'm acting as a hedger in the financial market. Make sense or not? Is the difference clear, guys? Your answer should
Yes.
reflect that. Yeah?
So
Yeah.
can you explain the arbitrager part also once again?
Yeah, arbitrager is someone who is trying to make a risk-free profit. Okay. Usually, what do we see? If you want to make returns, you have to take risk, right? More risk, more return. That's what we have learned. But what is arbitrager trying to do? Arbitrager is trying to make profits without taking risk. Resol, please mute. There is a disturbing noise. Yeah. So arbitrager is someone who is not taking risk to make returns. He is trying to make returns without taking risk. Obviously, the returns would not be much. It would be very, very small. But he's trying not to take any risk to make those returns. Okay. Just for simplicity's sake, I gave you an example. Let's say you buy the shares on BSC at a lower price and you sell them on NSC at a higher price. Okay. So you are simultaneously doing the buying and selling of shares. So no risk, right? And you are making some profits. So that is arbitrage. He's trying to simultaneously buy low in one market and parallelly sell high in the other market to make risk-free profits. Are we clear?
Yes.
So can you explain settlement?
In settlements,
Yes, sir.
settlement of what? I mean, what is your question exactly?
Sir, the gross settlement and the net settlement, the thing you have explained earlier, buys and sell, trade
Okay,
one, trade
I
two.
don't worry about it. Don't worry about it. Basically, in gross settlement, um, you exchange all the amounts, yeah? Whereas in net settlement, you just exchange what is the net of amount. Okay, for example, if you have to pay me 150 rupees, I have to pay you 100 rupees. So you just pay me 50 rupees, right? That's a net settlement. But if you pay me 150 and I pay you 100, that's a gross.
Okay, sir.
Okay, guys, any question?
Sir,
Yeah.
sir, can I also leave the class? Actually, I have some topics left to revise.
Okay, I hope you will do well tomorrow. Okay.
Okay, sir.
I
Thank you.
mean, whoever is leaving early, I hope they would be studying. Okay.
Yes, sir. Thank you.
All right. Yeah. No problem.
Sir, can you mark me present? My name is Moksh.
Yeah, I'll mark you present. Don't worry.
Thank you, sir.
All right. All right, guys. Let's take a 10 minutes break, 15 minutes break here. You can just scroll through your notes quickly if you want. If anything pops up in your mind, any doubt you have in any topic we discussed, I'll be there
Sir,
to
Rudraksh
ask you
has a
questions.
doubt.
Rudraksh, okay, he has put it on the chat box. ADRs. Okay, anybody would like to take this question, guys? What are ADRs? Why would any company issue ADRs? How are they issued? Yogita, Zenat, I don't think you have answered any question. So would you like to take up any question? This question, what are ADRs? Yogita, Zenat, are you there? See, Rudraksh, what
Yes,
happens
sir.
is,
I'm there.
yeah,
Sorry, sir.
Zenat.
Actually, some problem in. Yes, sir. Sorry. Actually, I'm not about ADRs.
Okay, all right, Zenat, no problem. Okay, Rudraksh and Zenat, both of you can listen to this. ADRs are American Depository Receipts, right? So for your every need, there is an instrument. Yeah. Now, for example, if you have long-term capital needs, you can issue equity, you can issue bonds. If you want short-term capital, you can issue commercial paper, certificate of deposit. Similarly, if you have a need of raising money from American market, okay, if an Indian company wants to raise money in the American market, what is the instrument? American depositories. Okay, so in general, depository receipts are the instruments which are used by domestic companies to raise capital in foreign markets through equity. Yeah. Now, American depository receipts are specifically the depository receipts which are issued in America. Okay. So let's suppose an Indian company wants to raise funds in American market, they can raise the funds by issuing ADRs, American depositories. Okay, so what will they do? For example, let's say TCS wants to raise capital in America. The TCS would take out some new shares and give it to the local custodian in India. The local custodian in India would then further transfer them to a local custodian or a global custodian in US. Okay, there we have usually the structure where the custodian and depositories work together, or if they are working separately also, the custodian would instruct the depository to issue securities against them, against those new shares of TCS. Yeah, so depository will issue securities against those shares, and those securities would be known as American depository receipts. So anybody sitting in US who wants to invest in TCS can invest in TCS through TCS ADRs. Yeah, as the share price of TCS will move, the share price of ADRs will also. Okay, does it make sense, Rudraksh? Okay. Yogita, I have not heard anything from your end. Are you there? All right, yeah, Razul, we are taking a break. Let's take a 15 minutes break, guys. Let's regather at 12:10 and we can discuss further important questions. Okay, see you guys. Bye. Okay, let's continue, guys. Everyone, please come back.
Yes, sir.
Okay. Let me quickly take the attendance before I forget it, guys. Okay, Ashutosh. Mansi, Moksh,
So he was present.
Parichay,
Present, sir.
Yogita,
Present, sir.
Anushka,
Present, sir.
Paridhi. Paridhi was present. Diksha, yes, Diksha was not here, right? Rudraksh, Rudraksh is here, Razwal is here, Nasreen was here, Zeenat is here, Raveen is here. Okay, so people who are marked absent are Mansi and Diksha Sharma. Okay. All right, guys, we can continue now. Okay. So anything you want to ask, or should I ask you the questions?
So I have a question.
Yeah, ask.
If we settle the transactions on settlement date, then what is the use of expiry date?
Uh, can you elaborate more exactly where you are referring to?
So like an expiry date, like there is a like in settlement date we settle the transactions, but in expiry date the contract gets expired. So if we are setting the transactions on that day only, so then what is the use of expiry date?
No. So from where are you referring to this? I mean, do you have an example in mind, or are you referring to some notes or something?
No, sir. In notes I have read about expiry date, and matlab, it's not specifically in the notes, but in general.
See what happens. Let's say you have an expiry of last Thursday. Okay, you have an expiry date of 30th September. Yeah. Now, what would happen? The settlement may take place a day or two later. Okay. For our understanding sake, we understand it as 30th September. But if you are saying that, okay, I'll buy the shares of Apple on 30th September, that means on 30th September, you
Sir,
would get, yeah,
sir, I just missed some minutes. Can you repeat some minutes?
yeah, Rajwal, try to be on,
Sir, sorry.
I mean, be attentive, okay? It's suddenly you jump into the discussion and say repeat. See, yeah, what we were discussing is that let's say 30th September is the expiry date. So it's like we are saying that on 30th September we'll do something. Yeah. But I need to know what is the price on 30th September, right? If I'm looking at gains or losses, so I need to calculate the gains and losses based on what is the ending price on 30th September, right? So only at the end of 30th September, I'll get to know what is my profit and loss. And then I may take a day or two to give the amount to the other party, right? So that's when you say settlement has happened. Is it clear who asked this?
Yes, sir, it's clear now.
Oh. All right. Any questions, guys, from your side? Happy to
Sir?
take it. Yeah.
From LMS, I was reading something. So there was a topic of benefits of derivative. So one of the benefit was written as price discovery. Can you please explain this?
Yeah. What is the current market price of Dabur? Quickly, anybody can tell me.
So
643.20.
643.20.
Yes, sir.
Oh, it is up a lot today, huh? Okay, right. So it is over 40. So what's this 40 today? Okay, that is the current market price, right? Can you tell me what is the futures price? What is the futures price of Dabur for, let's say, 30th September? Guys, you can see it or not? I mean, you can find it at your end or not? Or do you want me to share the screen?
So please share the screen.
Okay. So for 30th September, futures price is 643. Yeah. What is the current market price? 643.25. And the futures price is this. So what does the market expect? What is the expectation, guys? Do we have too much premium? Is there any significant difference?
No, sir.
So the current market price is what it is trading in futures also. What does this signify? What is the market expecting? What does the market expect the futures price to be? I mean, on 30th September, what does the market expect the price would be? 643.4, right? So derivatives gives you an idea about what the market expects in future. Okay, so there is spot cash market, which tells us what the market is expecting currently. Yeah, I mean, what the market is, how the market is valuing the share currently. Yeah, but the derivatives market tells us what the market expects in future. So as I can see from this, that the market does not expect any significant jump in the share price of Dabur during this month, right? We are at the start of the month, and at the end of the month price is also similar to that. So that means the market does not expect the share price to move significantly in any direction during the month, right? That's how it helps in price discovery. It tells us about what the market is expecting in future.
Okay, sir.
All right. Any other question? All right, let me ask you then, what is the difference between OTC market and exchange traded market? How are they different? Yogita, would you like to try this?
Yes, sir. Sir, I am
Yeah.
audible.
Yes, Yogita, you're audible.
Okay. Sir, exchange trading are under the supervision of some regulatory authority like SEBI supervises the exchange trade, and whereas OTC they are not supervised by any regulatory authority. And in exchange traded there is price transparency, and in OTC market there is no price transparency. And in exchange traded order execution is not guaranteed, but in OTC it is guaranteed. In exchange traded settlement is guaranteed but not guaranteed in OTC. We know the counterparty in exchange traded, and we don't know we don't know the counterparty in exchange traded, and we know the counterparty in OTC market.
Absolutely, all the points are correct. Yogita, you mentioned that there is price transparency in exchange traded market. What do you mean by the term price transparency?
Like all the prices are there on the exchange trade. So everybody knows the price. They are transparent to each and every person.
Yeah, so by price transparency, we mean at what price the trades are happening, what is the order book looking like, what is the sell book looking like, right? So, I mean, what are the buy orders, what are the sell orders, what is the current market price, everything is visible to you, to everyone, right? So that's why we say it is transparent. Whereas in OTC market, it's a deal between the two parties and we may not exactly know at what price they have dealt with, right? So there is not enough price transparency. All right, good. Why do we have margin requirements in case of future contracts?
So to initiate the transaction.
To protect the clearinghouse.
Absolutely good. Okay, good, Anushka. So the margin money acts as the performance guarantee that you will not run away. Okay, so it acts like a protection or the buffer or the margin for the clearinghouse that they have the protection that you don't run away. Okay, so it's like a safety security deposit for the clearinghouse. Okay, good. What is a margin call? When is it triggered?
So when the margin requirement goes below the minimum margin, then the broker calls the investor.
When the margin balance goes below the maintenance margin, that's when the broker triggers the margin call. Okay. What is mark-to-market process in case of future contracts?
Daily calculation of profit and loss and adjusting the balance.
Absolutely. Okay. As the prices are changing, based on that daily calculation of
Sir,
yeah.
sir, in the maintenance margin, we have to calculate that mark to market.
Sorry.
Sir, in the maintenance margin, we have to calculate the profit and loss of the. You said mark to market in that.
Yeah. So the daily calculation of profit and loss based on the change in prices and adjusting of the margin balance is known as marking to market. Okay, it's a feature in the futures contract, not in the forward contracts. All right. Why would somebody sell a call option? Guys? Please listen to my question carefully. Why anybody would sell a call option? I'm talking about short call, okay? Why would somebody take the position of short call?
If they believe that the share price in future will go down,
Sir,
If it expects the share price to go down, would not that person buy the put option?
So can you please repeat?
My question is, why would somebody sell a call option?
to get the premium.
Okay. Yeah, you definitely get the premium. What is your expectation? What is your view on the market? See, if you expect the share price to go up, you will take a call option. Yeah, you will buy a call option. If you expect the share price, asset price to go down, you will buy a put option. Now we are talking about when will you sell a call option. If I don't expect the market price to go down, let's say, yeah, but I don't expect it to go up either. Okay, listen carefully. What I expect is that it would remain stable. Okay, it would remain close to what it is currently or slightly go down. Okay, I expect it to remain stable at what it is currently or expect it to slightly go down. I definitely don't expect it to go up. So I most probably in my expectation, it would remain close to what it is or may slightly go down. What is the best option to do that in that case? Sell a call option, okay? In that case, you will sell a call option. Make sense or not?
Sir,
Yeah.
sir, in this we believe the seller believes that the price is not fluctuating too much, and then his loss would be minimum, and the option premium he gets would be more than the loss.
Yeah. See, the objective is, okay, let's take one example. That would be easier to understand. And referring to this sheet which we discussed, okay, I hope you remember we did this, right? So when will I buy the, when will I take the long call option? I'll take this position when I expect the asset price to go. That's very simple, right? And if I talk about long put, from the diagram, I can see that obviously my gain is when it goes down. So I'll take this position when I expect the asset price to go. Now, what do you think, guys? Here? When will I take this position, short call? Okay, when am I gaining? My maximum gain could be just $5, right? When will I do this? When will I take this position? When I expect the asset price to remain stagnant, okay, or may slightly go down. Read this line twice, guys, if you have any doubt. If I expect it to significantly go down, if I expect it to really go down, I'll take the put option, right? But what am I expecting here? I don't expect it to go. Let's understand it from this perspective. I don't expect it to go up. Okay. In that case, I most probably feel that it might remain stable at what it is or may slightly go down. I'm not sure. But what I'm sure about is it will not go up. That's what I'm very confident about. So let's say if I don't expect it to go above 650 rupees per share, what will I do? I'll sell all options of strike price 650. Don't you think I'll do this? If I don't expect it to go up 650, I'll sell a lot of call options with strike price of 650, 660, 670, 680, 690, right? Because if I sell these call options, I collect a lot of premium. Yes or no?
Yes.
Sir.
Yeah, and I don't expect this to be useful for the other party. I don't expect it to go up. So obviously this will not be used. Okay, can you tell me when will you short put? When will you take this position? Based on those only, those inputs only, I mean, when will you take the short put? When do the price to go down? Okay, I am not sure whether it would go up or not, whether it would remain stagnant, but I am sure about that it is not going to go down. I don't expect it to go down below 550, let's say. So if I don't expect it to go down below 550, then what would I do? I'll sell a lot of put options of price and collect premium. It's just the opposite of that. Guys, I hope it makes sense. I'm not hearing from you, but if there is any doubt, let me know.
Sir, why are we taking a reference of 550 here as a strike price?
I've just taken it for reference. For example, you can take any, for example, let's say, what is the current market price of Dabur? 640, right? You don't expect it to go down below 600. Okay, you don't expect it to go down below 600 now. So what you can do, you can sell a lot of put options with a strike price of 600. If it is giving you 2 rupees premium per share, you can collect a lot of premium, right? By selling those put options. So you can take any price. I'll just take an example of 550, but it is based on the expectation of the seller.
Okay.
Sir, the underwriter would be seller here in the short put and short put.
Underwriter.
Yes, sir. Yes.
See, we call the person who sells the options as the writer of the option.
Sorry, sir, it's right.
Yeah. So you are writing a put option. Okay. When will you write a put option? When you expect this, right? Are we clear, guys, everyone? Any questions you have, anything you want to ask regarding mock interviews or level 1, let me know.
Sir, attendance is done today, sir. I am present.
Attendance is done as well. I marked you present. Okay. All right, guys. So if there are no questions, we can close for today. And I wish you the best for your level 1 mocks.
Sir,
I'm sure
Rudraksh
you
has a
do.
question.
Yeah, Rudraksh.
So in
So
the
please
chat
tell
box.
how to answer mock question. Should we start with the definition followed by an example? Absolutely. I think, Rudraksh, we have discussed this in the Viva session we had, right? How do you answer the questions? Okay, you have to differentiate yourself from just a graduate, right? So you give a proper definition. I don't want you to mug up anything, okay? The minute I see you are mugging up, I'll make sure you get confused. Okay. I'll ask you such questions that you will get confused. So don't mug up anything. I mean, some terminology you need to mug up, but that's okay. But don't mug up 3-line definitions. That will clearly not reflect well. So whatever concept you just need to explain that. And then maybe to explain it further, you can take an example or any application of that concept in real life. That would give a clear picture to the interviewer. Okay. And that is why, guys, I request you to participate in the class always. Okay. I see few people participating. Once you participate, then only you will realize where you could improve. Okay. How you are giving the answer, how I am giving the answer, where is the gap, how can we fill it. If you participate, if you try, only then you would come to know about your shortcomings and you can improve. If you just sit in front of the laptop and listening to me for 3-4 hours, then close down everything, won't really improve you that much. Okay. You need to be active and participate in the session. Any other question, guys? All right, so I think we can close. We have discussed almost all the topics through question and answers. All the best for tomorrow, guys. See you tomorrow. Bye-bye.
Bye, sir.
Thank you, sir.
Thank you, sir.